Hi, everyone. Thank you very much for joining me today for another edition of Morning Joe and Velocity Banking. Four aspects that I'd like to talk today very briefly. One of them is the difference between when you see a mortgage being compared to Velocity Banking and making extra payments or dumping your check into a HELOC and paying down debt. When I've been making my mortgage payments, and I have two additional ones, it was a payment method that I was using. Now that I'm using Velocity Banking with a debt tool or a HELOC home equity line of credit of $50,000, this is a cash flow method. And the cash flow method is that now I'm putting my entire paycheck, for the most part, and about $46 being left out, into a HELOC. And then from that HELOC, similar to a checking account, I'm paying down my debt. And the money that's sitting on the HELOC after my debt is paid, that's helping to pay down the principal balance. That leads me to time. So as a result of time, I've compressed from having a mortgage of 30 years to I compressed it down to 1 month and paid it off. Now I'm using a cash flow method to pay down debt in general. Also the balance. So the balance that I initially started with was about $46,000. The cash flow method or the HELOC that I obtained paid that off, and now I'm paying through the HELOC. I'm trying to get another HELOC to increase my cash flow method and move away from payment methods. And let's go ahead and get into it. Let me share my screen. All right, so in looking at my screen, I applied for, which one? In looking at my screen, I applied for another line of credit. And I'm gonna look at, maybe looking up also because it's on a bigger screen. So I applied for another HELOC in general. And this one said that I can borrow up to 62,152 on another property. Now they pulled the credit, they did a soft pull, and on the soft pull of the credit, it resulted in showing that I have monthly debt obligations of $3,187, and I have total outstanding debt of $320,000. Let me get that a little bigger. See if I can get that a little bigger. $320,000. You don't need that. Go ahead and delete that. And so now I go to the other part of the credit report. So it's still the credit report. This is my total debt as it stands with me being an authorized user on someone else's credit. With that in mind, it's $3,187 a month, still $323,546 outstanding debt. If I remove myself from that credit, then my monthly report should go down to $2,466 a month and about $280,000 in debt. I may need to check that out because it shouldn't be that low. Yeah, I may need to check that again. In looking at what they first indicated, so my debt to income ratio, which the lenders used, was 44.99% at this present time. When I first started in December of 2023, my DTI was probably December 2023. I think my DTI was between, I'm gonna say 50 to 55%, and it may have been even higher than that. At the present, when they pulled this TransUnion report, my profile was 678, and this was a soft pull. And there are some things that are still on the credit report that needs to be changed, or I thought was updated. Now I'm looking at the HELOC that I currently have. And what has happened is that my interest rate has changed. I was at 10.25, now I'm at 9.75, and that may have been a result of the change in the environment by the Fed. I'm sorry, and they may not have, because the mortgage interest rate, from what I understand it, they're kind of like tied to T-bills or treasuries, and I'm trying to get more information on that and learning that also. So with a nearly 5% change from 10.25 to 9.75, that would have resulted in saving 20.52. So I should be able to pay this HELOC off even faster with the new lower interest rate. If you can see this, you can see the screen, you can see the difference of about going from 10.25 to 0.75. It was about a 5%, but to be exact, it was 4.878% change. Okay, why the change? And looking at this box, why the change? Well, it could be the feds having some sort of influence, the current profile that I have or that's put together, overhead of lending organizations who I'm going to, and then the size and the type of loan that I'm getting. Because I have multiple properties and I live in an apartment, I do not live in a home. I'm depreciating all of my properties through my business. So I have an investor HELOC. And I think this one is 35% of the value of the home. So the home was valued at 245. And let me pull up a calculator right quick to see. So the home was valued at 245, or let's divide 62 151. 62 151 divided by the home value of 245 of the investment property. So it appears that they're giving me 25.37% of the value of the home. So 25.37% of the value of the home. All right. So one of the rates that are being calculated, I think I can do a 20-year term or a 30-year term. If I take the full amount of 62,151, the interest rate would be, the monthly payment would be at 704 at an interest rate of 13.75. Now, I thought with the change in the interest rate and my previous one went down, they're now showing it has increased by at least 14 points. So I want to see what's the difference, and I'm gonna call them Monday to see why the different changes. I had the expectation that I will be getting even a lower rate than the first one I got at 10.25. But maybe it's the risk factor also. All right. One of the other things that I wanted to just kind of share is with this thing called reserve fractional banking. And I wanted to share that with you so that you can have an understanding of it if you hear it. So I'm going to play this brief video on reserve fractional banking. And in general, from my understanding is if I take $10 into the bank, they're able to lend out 100% on my $10. So in addition to that, that means each time that I put money in the bank, I'm also increasing inflation against myself. So the millions of people that are getting out loans, whatever type of loans is in general, we are fundamentally increasing inflation, because then the banks can turn around, use the money, make out more loans at a higher interest rate, more money, chasing more dollars. We're actually increasing the inflation against ourselves each and every day. So let's check out reserve fractional banking.
Banks are allowed to create money through a system called fractional reserve banking. Whenever you deposit money, the bank is legally required to keep a certain percentage of it somewhere safe, but can lend everything else. Here's an example based on a 10% reserve requirement. John goes to his bank and deposits $1,000. John's bank keeps $100 and lends the remaining $900 to Mike. There is now $1,900 in the financial system. John's $1,000 deposit and Mike's $900 loan. Next, Mike uses the $900 to buy a laptop from Karen. Then Karen deposits her $900 at another bank. The bank keeps 10% and lends the remaining $810 to George. There is now $2,710 in the system. John's $1,000 deposit, Karen's $900 deposit, and George's $810 loan. This goes on and on until John's initial $1,000 is turned into approximately $10,000. Believe it or not, commercial banks actually create more money than central banks.
All right. So as indicated, commercial banks create more money than the central bank. But one of the main things I wanted to point out too is that whenever we get more loans in general and the banks put out more loans, we're actually increasing.
Fractional reserve banking
I'm sorry.
and full reserve banking. How do they work? Do they have advantages and disadvantages?
In general. I'm gonna share my screen one more time. There's a book that kind of talks about the history of the fractional reserve system. And that book is called The Creature of Jekyll Island. It gives a historical account of how a group of individuals, wealthy and powerful, met in Jekyll Island, which was, I think, about an hour and a half from where I grew up in Savannah, Georgia, and had an impact on creating the fractional reserve system. It was surprising to know and to learn that the system was created, now used worldwide, right off the coast of Georgia, across from about an hour and a half where I grew up in public housing. Let's see. So, and these are, this is the public housing project complex that I grew up in Savannah, Georgia. I lived there approximately 25 years of my life. They tore them all down and put up more housing, and these are some of the more recent units. And in doing that, there's the idea that if you put low income people near more affluent people, then they should pick up some of the norms and values of those individuals. All right. So yeah, again, just wanted to come in and share that my current HELOC has decreased from 10.25% to 9.75%. Should save me about 5% each month in going forward. So that will help reduce the debt. Reserve fractional banking, if you have a chance to look that up and see how the lending of money within our society fundamentally creates inflation against individuals. I wouldn't say against, well, inflation is just created. So by if you just allowing your money to sit, every day somebody else is getting the loan and more money is out there, and that more money is chasing fewer goods and services. So if there are fewer homes out there and more money is put out there, then that's going to increase housing, that's going to increase rent, that's going to increase food costs, whatever. There's a smaller amount of scarcity and they put more into the system, then it's going to have an inflationary impact. So that's one of my angles as a political economist. That's the disclaimer that I give for my videos. I am not a certified planner. I'm not a CPA. I'm not an attorney. I'm not an economist. I'm a political economist that look at the interaction between government decisions and the economy, free market economy, capitalist economy, and how it has impacts on individuals. So I've been able to successfully move from 12 credit cards down to 2 credit cards and work with clients to try to increase their wealth and asset building and improve their credit through the use of HELOC and velocity banking in general. So if you'd like to work with me or my team, my information is in the bottom. You can give me a call or shoot me an email. I'd love to talk to you. Thank you very much. Have a great day.